right, we're going to jump over now to naked puts. Got a question from Robert, the first question that came in live. And Robert says, how can you assure a delta neutral position selling a cash secured put? Okay, so whenever I sell a cash secured put, of course, we're talking about a naked put position. We're selling usually an out-of-the-money put. We might have a delta of somewhere between 0.4 to 0.3, depending on what your target range is. Now, this is a negative delta, of course, but if the stock moves up, that's what we want to have happen, because we put will expire worthless and we'll keep the premium. But puts do have a negative delta. However, we sold this, didn't we? We sold this position as a negative delta, so that kind of means it's a positive delta. We'll expect to see gains as the stock moves up because we're in a negative position on a negative delta, roughly. So how do you make it delta neutral? Well, you do anything that you can on the side to have a negative delta. You might convert it to a straddle or strangle. I don't like suggesting that, but that's what you'd probably look to do to be delta neutral. Let's just take a naked put position here. You could also do the math, Robert, and try to go go short shares of stock at a certain price to be delta neutral. But now you're sort of countering yourself, aren't you? You entered into a bullish cash secured naked put position. And you might end up shorting, let's say, 20 or 30 shares of stock, which gives you a negative delta, so now you're delta neutral. Well, if the stock goes up you expect, you're going to lose on the short stock position. If the stock falls, you lose on the naked put. So you're still delta neutral for a moment. And that's the problem I always have with delta neutral. Let's take something that's not too extravagant. Whirlpool looks good. I'm avoiding Beyond Meats because it's it's got a high volatility. At least it did. I haven't checked it recently. We checked. Yeah, it's at 0.9381. Everything's relatively high, but I'm going to use Whirlpool. A little bit lower volatility. And I apologize. Your delta here is a good, nice number of negative 0.35. Okay. And so we'll do one contract there. Okay, so when most investors talk to me about doing a delta neutral, what they commonly start off doing is they're doing a long straddle or a long strangle and then going long stock or short stock to have the position remain at delta neutral. Okay? You know, maybe they have 20 contracts and they're doing 80 shares, something along those lines. That's one structure that's commonly used. Here we know we're in a positive delta of 0.35. Right, our delta was positive. It's negative 0.35 for the put, but we're selling it, so that becomes a positive 0.35 delta. In other words, if the stock moves up 1 point from 109 to 110, we'd expect to get 35 cents decay. So lose 35 cents of this premium in that case, not increase, but decrease in our favor, positive delta. So if I have one contract, you might end up looking to short shares of the stock. Okay, that would give you a delta. You could maybe short 3 shares, 4 shares, 5 shares. If you're using 10 contracts, it might be 30 or 40 shares along those lines. Now, the opposite end of that, of course, is we could find the call. We could find the call with the comparative delta, since we're going to be shorting. I'm sorry, I got to go out of the money here. My delta point, wow. That's why. Everything looks strange, and now I know why. My apologies. 0.35, perfect. It's the 106 strike for the call. Okay, kind of same, isn't it? The put versus the call there. So we've got a I was in the put only chain. I'm sorry. There we go. 112. That's better. 112 strike, positive 0.35 delta, but we're going to sell it. So it's going to be a negative delta, Robert. Okay? So let's go to our 112 strike again. 7 days out. Selling this for less premium than the put, but again, at this point, I'm delta neutral. We've got a positive, negative, 35 delta. Delta neutral in this case. Now, what's tough about this? Well, it's a short strangle position. Margin requirement is going to be pretty hefty. Return is going to be difficult because you didn't get as much for the other call, but you still have to increase the margin by almost the same amount depending on your broker, what they charge you for the short strangle combination. But of course, as the stock moves up 1 point, what's going to happen? Our put is likely going to see a decline in delta. Well, it's going to see a decline in gamma, but the delta is going to drop to 0.30. And the call is going to go up to 0.40. Remember, this is a positive because you're negative a negative, and this is negative because you're negative a positive. So now the call's at a higher delta. So now you've got to decide how to manage it. You've got to make up what? 10 delta to the positive side, or curb 10 delta from the negative side. If you have multiple contracts, you could consider selling some of the calls to remain delta neutral. I apologize. Buying back some of the calls to remain delta neutral. You could buy shares of stock to hedge some of the negative 4 delta here to cover a delta of 0.10 positive, so now you're back to 0.3 to 0.3 on the position. You could increase the number of puts, sell more puts at this point as the stock's going up, which might not be a bad idea, to try to get your average delta on the puts to 0.40, okay? Buying a put is tricky, okay? So the comment came in, well, why don't you just buy a put? Well, see, buying a put's tricky because we were talking about the 106 put here with a 0.35 delta. That's our naked put. For this expiration, what can't I do? I can't buy the put with the 0.35 delta to be neutral to counter what I have with the short put, because it'd be the same put. I'd be long and short. So in that case, you now have to either ladder a position in the same expiration, which becomes difficult. So you've got your 106 put here with a delta of 0.35. And then if I bought one here at 103 that has a delta of 0.2, and then bought one at 100 that has a delta of 0.15, I've now got a laddered ratio position. But I've corrected the delta. In that case, it's going to have a margin requirement, but not as much as the cash secured. But the profit and loss chart is going to be entirely different. It's not going to be the naked put profit and loss chart that you were originally looking for. Neither is that short strangle, by the way, unless you're really confident that the stock wouldn't hit that other short call strike price in that case. So that's the balance, okay? So let's say that I'll be accurate. Let's go back to the chain. I'm going to go to the put chain. To try to keep the math simple, I'm going to try to find our 10 delta and our 15. I'm sorry, our 20 delta. It's the 103. Close enough. And the 15 will use the 101. That'll be 35 delta. We're going to buy those two. So the 103, 101. Okay. There we go. So I'm buying one of each. Now I'm going to have about a 0.35 delta negative on my longs and a negative 0.35 delta for the one that I sold. You were in a bullish strategy. Now you're in a bearish strategy because it goes infinite profit to the downside. You know, it doesn't show it all the way down here to 0, but this would just keep going up, 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 up because you've got 2 puts to 1 short, but it's not at a profit level on the upside in the direction you thought the stock was going to go. That's why sometimes that's not the best approach, in my opinion, is to try to do some kind of ratio with laddering those positions. It becomes a little bit more difficult, okay? So in any case, Robert, that's what you're kind of looking for here to analyze and to kind of take a naked put position and try to build it as well. Okay, William offers a counterpoint. It's not a counterpoint, but it's a thought on this. And okay, here we go. He says, for the Whirlpool position, to make it delta neutral, you could sell to open 2 call credit spreads, to reduce the margin instead of doing the short strangle, and play the spread width and or expiration to get the whole position delta neutral. Yeah, so if I found a bear call credit spread, for example, excuse me, with a 0.17 combined delta, I could do 2 of those, and it would get me close to the 0.35 delta here. That's sort of what he was saying. Now, in this case, you only have to cover the margin requirement for the bear call instead of the full naked position. You might be closer to at the money, though, which is tricky, right? Because I'm going to be selling one at 1 strike. With this one here, the 112 is at 0.35. So I could probably do the maybe 115 and 117 and get away with a 0.17 delta, and then do 2 of those. And that would give me delta neutral, but again, what does this do to my position? It takes care of that extra risk here, but I still got to cover the full margin for the cash secured put. Gives me a little bit of a wider change, that's good. Gives me a capped upside, that's good. Probably didn't give me, well, no, it did give me a decent amount of credit here, so we're at a 2.1% return on the position. So thank you, William. That is a good idea. I didn't think about that in that case. So that's something that you could consider there, is looking at bear call spreads and doing twice as many, finding a bear call spread where the delta difference between the two is that 0.17, and maybe doing 2 of them in this case to balance out the delta neutral. All right. So Robert, that's the best I have on that. That's the best I have. And of course, what William also said is that now as the stock moves, you could play around with the expiration date. You can play around with the strike width to try to keep delta neutral, but you're going to have to keep managing the position consistently if you're trying to stay in the delta neutral capacity on that spread. And it becomes more like an iron condor position now, but really it's still extended losses to the downside on the naked put. That doesn't get hedged. You've hedged delta, but you haven't hedged the risk on the position if it goes the other way. Okay. Thank you, William. Excellent. Now, all right, Pete, great question. And I'm going to answer your question, of course, Pete, but I'm going to start it this way. Pete's question is, if you have a bull spread using put, so we're talking about a bull put credit spread, and the stock goes against you, do you consider rolling down the bull spread? That's one of the least of the 8 ways that we teach to manage a bull put credit spread that I'll use. That's the least often used, okay? Now, before we get started, Pete, what I want to do here is I'm going to go to the main home tab. I'm going to go to free webinars, and I'm going to go to option strategies. And we're going to scroll down here on this option. Oh, here's the link, by the way. Sorry about that. Okay, so powerop.com/webinars.asp, and then click on the option strategies. And you're going to scroll down here. This is, I don't want to say it's homework, but this will something you can do later on. This one from about 2 years ago, 8 ways to manage a bull put credit spread. And in the first section, we talk about the trigger points that we'd look to maybe start considering managing the position. All right. Now, you're here, and I want you to check that out later for more full in-depth, but let's just review it real quick. Let's stick with Whirlpool. Let's go to the custom spread tool. We've just been using that as our example today. And we saw Whirlpool's at 108. So let's say for today's expiration, I had, let's do a 108, 110. Not quite below both strike prices, but let's say it dropped below my sold. I would have sold the 110 and bought the 108. And we're going to get about 40 cents for that. Okay. So we're going to, we're going to sell the 110. Say we did this last week. And we got 80 cents for it, and we paid 40 cents for this one. This would be about a 20% return. 25% return. All right, now the stock has moved between the strike prices. First thing that you'll see, Pete, is normally in that webinar, is what I normally do is I'll look to adjust the position if the stock reaches within 1% of that short put strike price. That's usually one of my first warning signs. But also, Using the bull put weekly search and power options, we're using certain technicals related to MACD and simple moving average. So if during this time, let's say it opened this position when the stock was at 112 and it had been moving up in price, if the stock falls below the SMA 20, so originally I would have looked for stocks that were greater than the SMA 20, but if during the time in the trade, if this reverses, or if the MACD goes negative, in other words, the MACD crosses below the signal line, because we want it to be above the signal line in a bullish pattern, but if those happen while I'm in the trade, that's also going to be somewhere I'm going to look to manage the position. I likely wouldn't have waited to manage it until here, but there is a way to manage now that it's there. And I almost forget the order of the 8, but let's say the stock did fall. Let's say I had sold, instead of this, I had sold the 108 and bought the 106. Okay, so it would be a lower credit here, but let's say we did the 108 and the 106, and now the stock's fallen to 108.80, pretty much close to that 1% rule. Now what is the first thing? Do nothing. Okay, so this has moved towards, in this case, you know, the one I graphed, let's just graph the other one. Okay, let me just graph the other one so it'll be easier. We'll just review quick sort of the 8 things that we suggest in this situation. Now that it's at with one, and let's use the 7-day out one. Now that we're within 1% of that short put strike price, let's drop to it. Let's use our 2-point spread there, and I'll use the current prices. Of course, I would have sold this when it was further out of the money, Pete. Naturally, not at the money, but there we go. Now it's dropped. Okay, so let's say my SMA 20 has been triggered. Let's say something else, and I'm within that 1% rule. Number one, 7 days to go, the stock's still above the strike, is do nothing. Okay, that is a management technique, believe it or not. So number one is do nothing. Expectation is that the market will maybe show a little bit more strength next week, move back up. Number two, close the entire spread. Take the loss and move on. And normally that's another rule you'll see in that trigger, that I try to keep the bull puts to less than 50% loss, meaning that here's a 2-point spread. My max risk is 170. I will try to liquidate this position if the debit to close, the loss on it is 85 cents or less. Okay, I want to keep it under 50% of the maximum loss. That's what I'm looking to accomplish. So I could just close the whole spread. No one likes to do that, but sometimes it's better to just close and move on if you've controlled it well enough. Number three, notice how I set this up with a $2 strike difference. I usually suggest doing spreads that are 2 strikes apart or more, because what I might consider doing is, if I'm still confident on this, we just had a bad day here, I've got 7 days to go, Pete, I might just buy to close the 108 and sell the 107. That's going to give me, if it can be done for a credit. If I can keep a credit but sort of increase the distance, I know it's only 1 point in this case, but if I think it's going to rebound, but I'm worried it might drop below 108, I can move down a strike. So close short and roll down 1. Okay, you leave the long open. Only do this, of course, if you can still keep a credit. It'll be about half of what you originally expected, but hopefully you can still get it. So close and roll just the short. Now, number 4, Pete, I would say is close the entire spread, 108, 106, take the loss, sort of 2, and then roll down to lower strikes, maybe a 106, 104. Okay, so this is an option. It's not always the best option. Roll down and out, whole spread. Okay. Number 3 and number 4 aren't always the best options, because you have to step back now that this position has gone against you, Pete. And you have to look at the position brand new. When you open this position, when I opened this, my bull put credit spread, it had everything I wanted. It had the SMA 20, it had the Bollinger Bands, it had the MACD, it had the return I wanted, maybe the probability I wanted. But now that the stock's fallen to near my short put strike price, what I have to look at is the research and analysis. I have to forget about what I thought about Whirlpool when I originally opened this bull put spread. Now I have to look at what happened in the last 10 days, 15 days, 20 days that caused the stock to fall. because it's highly possible that moving down one strike, even though it's only 7 days away, or taking off this spread and moving it down and then out another 2 to 3 weeks, maybe a full 4 weeks out in time, if it's going in this direction, what am I doing? I'm just increasing my chances for further losses. If the stock now does not match my goals, does not match my sentiment for this strategy, don't trade it with this strategy, even though you've been successful with it. And that gives me to number 5. If you analyze the position and you think the stock has changed sentiment, you might want to close the spread as we talked about, and then open the opposite. Maybe do a bear call spread at 112, 114. Instead of staying in a bull put, go to the bear call side. Close and do the opposite. Okay. Number 6, and these are sometimes out of order. Number 6 is if your sentiment has changed. It's harder to make a profit with this, especially if you only have 6 or 7 days left on a spread, Pete. But number 6 is close the short. Don't roll it. Buy to close the short, which is going to be expensive, and it's going to add to your cost basis of this long. But if your sentiment is you're still bearish, if the stock continues to fall and goes down to 104, 103, or 102, you're now in just a long put position with the cost basis you paid to buy back the short put as the price. You still kept that net credit that was already taken into account. Your buyback cost here is going to be the cost of this put. So if you think it's going to continue down, just close the short, leave yourself in a long put position. But you have to be bearish, right? Got to be bearish in that case. 7 is create the iron condor. Instead of 5, where you close the bull put and add the bear call, if you think the stock is stabilized right now from its decline, and it's not going to go further below your short put strike, and you don't think it's going to rebound to go up to 113 or 114, sell the bear call spread to create an iron condor. This one is not also one of my favorites, and the reason why is just what we talked about here with 5 and 6. I was wrong on the stock and it's moved against me, Pete. Now maybe something in my new analysis tells me that I think it was just a bad day and it's going to pull back up and I think it's going to end up in this range and the iron condor would make sense. This doesn't address any further downside loss if it continues to move against you. You could still lose the full amount on the bull put spread and you've maybe only hedged it by 10, 15 cents by adding the out of the money bear call for the same expiration. You did get 10 or 15 cents more. Another risk with the iron condor here is that not every broker reads it, that if you had a bull put on stock XY0 and Whirlpool and then you added a bear call to the other side, that they'd read that as an iron condor. What they're likely going to do is charge you the margin for both the bull put and the bear call. Whereas a lot of brokers, if you add an iron condor, they just charge you one side or the other because they know you can't lose on both unless you start managing the position and buying and closing legs at different times. But that is an option. It gives you a little bump in the premium as well. Now, number 8, we won't go through now. It's a little different. It's if the stocks between the strike prices just had a sudden fall, and that's called the pendulum adjustment. And that's where we'll move the long put, in a sense. I'll leave the short put where it is, but if I can manage it, stocks trading between the strikes, I'll sell the 106 and maybe buy a 110 for a debit. What's that going to do? Well, I'm just swinging this like a pendulum, and it'll end up creating a bear put debit spread on a stock that's declining against me. It gets tricky to do sometimes with the math, and I've found it only really works when the stock is between the strike prices. It doesn't work if it's getting near the short put, and it doesn't work if it's dropped below. Now, these are all management ideas if you've got a position that's moved against you and likely you're under that 50% loss of the total expected. If you're in a bull put credit spread that got away from you and you're near an 80, 70% loss, meaning I'm up at a $1.50 or a $1.60 loss and it's below both strike prices and I only have 5 days to go, you could roll it down and out, but what you're going to experience is how you're going to get back a $1.50 loss. One of two things. You're either going to have to go out several months or you're going to have to drastically increase the strike prices and still go out maybe 2 months. Why do I have to increase the strike prices? Because I'm not going to get a $1.50 on a 2-point spread, even if I go 2 months out in time. I'm going to have to go to a 5-point spread. I'm going to have to go to a 10-point spread probably, maybe 7.5 to get a $1.50 credit while still going 2 months out in time. Why is that risky? Because now you're increasing the margin to 7.50 or 10. You're increasing the max risk to 7.50 or 10. If the stock continues to move down against you, you could lose 3 or 4 times the expected original loss you had on the position that you could do right now. Okay? All right. So webinar will help you with that as well. It'll review those 8 ways for you a little bit more in depth, Pete, there as well. And take a look in that webinar section again, and you'll be able to, you'll be able to go through all those more in depth, as well as the income method number 8, the pendulum adjustment that we didn't see here. Okay?